Hi, everybody. Welcome to another episode of the 7 and 7 Show with Zack Ellison. Today, I have with me Priscilla Guevara, a general partner at Science based in Los Angeles. And Priscilla, thanks for joining.
Thanks for having me, Zach. It's good to see you.
Likewise, we've known each other for a number of years now, and I'm excited to finally
Oh,
have you on the show.
I know, me too.
So tell us what you're doing now at Science, and then also, more importantly, how you got here.
Sure. So, as you mentioned, I'm a general partner at Science. I've been with the firm for about 6 years, and I have a very storied history on Wall Street. So, I lived in New York for over 20 years. I started my career structuring derivatives, so very different from what I'm doing today. But I do believe there's a lot of overlap now in terms of the capital markets. I spent my time at Sumitomo. I moved over to Neuberger Berman, and then I was at Moore Capital between New York and London. Launched a company that was sold to a compliance consultancy. That firm was called Strategic Enforcement Advisors, sold to ACA Compliance. And prior to Science, and I was at business school, and then I was at Anheuser-Busch, and I covered their tech portfolio. And I met Science, Mike Jones, one of the founders, and really fell in love with the story. Science is well known as a venture studio based in LA, and we work really in the consumer space. And so we work with early stage founders, helping to scale them, build them, and bring them to exit. And so that's where I'm at now.
Excellent. And you've done some really big, well-known investments, including Liquid Death.
Oh, yeah.
I
That's
wanted to talk about that because I always thought that was a bit of a counterintuitive investment in the sense that it's canned water and it's called Liquid Death. So how did Science get involved and how did you get involved?
Yeah, sure. So I joined Science in 2018, just before Liquid Death joined us. And so our thesis is really around these shifts and movements in culture. So we were founded in 2011. Moving into 2017 with our fund two, we had this thesis around consumer authenticity, the removal of plastic on the earth, and better for you health. And really, when we met Liquid Death, and you probably heard the story already. But Mike Cesario and his co-founder, JR, they were going through Snapchat's accelerator. And Snapchat's accelerator is really known for brand building. Evan Spiegel introduced the firm to Science, Peter Pham, one of my partners, and really said, you guys are a CPG company, you need to go to Science. And so when we met them, they had one product in market, which was the still water, and they were distributing through a few East Coast distributors. And again, it met our thesis. We met Mike and JR. And Mike Cesario, his background is very similar to Michael Dubin from Dollar Shave Club, another company that we incubated in our offices and sold to Unilever for $1 billion. And when we brought in the team, we made our first investment, went on Amazon. And if you go on Amazon, they started these fan fiction comments. And so, I mean, these stories in the comments that gave us the external validation that there's a growing consumer interest. And again, going back to that thesis of consumer authenticity, consumer virality, it really met that, right? So from the standpoint of, we have a canned water, it's aluminum, 100%, infinitely recyclable. So it met that sustainability component. It has that cool factor, right? If you are a person that doesn't drink, let's say you're vegan, you want to remove plastic. I can be at the bar, I can be at a concert, and I can still look really cool. I wish I had my can right here. And again, it's that third lever of consumer virality and consumer authenticity that really drew it for us. So we've been with the brand, building with them in our offices since 2018, and most recently announced their Series F, which was valued at 1.4 billion. So very excited to be on this journey with them.
That's fantastic. So tell me more about Dollar Shave Club. I think a couple of the founders there were graduates of Swarthmore College, where I went to undergrad, if I'm not mistaken. And they're based in Venice, California, correct?
They are. So Mike Dubin, and I believe he went to Emory. And what's interesting about their brand, we sold it to Unilever. And so that was years ago. That was through our fund one. And again, I mean, you can read the stories, but Michael Dubin came across these razors. And when we were moving in with them, again, it's that shift in culture. Back in 2011, there was this movement towards purchasing e-commerce, purchasing online. And so when we brought in Dollar Shave Club, this is again before my time, but my team helped to revolutionize the subscription box model. And so it's, how do you work? How are consumers purchasing, right? Where are they spending their time, their money, their values? And that happened to be online at the time. And so found an easy way. You purchase a razor for $1, it's on subscription. And that was very attractive to its buyer, Unilever. And so that's where they are. We're no longer affiliated, other than obviously we had that exit, but Michael Dupin still remains a close friend to us, and we're excited about the story. And it was at the time also LA's first $1 billion consumer transaction. So that's great.
That's great. So science has really been involved in some of the biggest Southern California deals of the last 10 years or ever, really.
Yeah, no, it's been exciting. You know, science is really known as a venture studio, right? So building, so not just a traditional fund. And so I think that's what's really exciting, is that we're seeing these companies at the very earliest stages. And so for many people to actually see it on the entire journey with us has been, yeah, super exciting. We're seeing big companies and $1 billion exits, and that's what we're working towards. We have one other as well that was, again, that movement towards pet ownership. So we have a company called Dog Vacay that was merged with Rover and had its second exit recently to Blackstone for 2.4 billion. So another fun one there.
So 3 unicorns coming out of the venture studio.
Yeah, exactly.
Not bad at all. It's funny because a lot of folks, I think, haven't really given LA and Southern California the respect that it deserves as a great market for founders, but also for VCs. But I think that's starting to change, and you guys are one of the leading reasons for that, I think.
Yeah, you know, it's interesting you say that. So having been in New York, and at the time when I met Mike, I at the time did not know science. So a mutual friend of ours said, "Oh, you're going to LA, you're doing diligence on a company," at the time when I was with ABI. And they said, "Meet Mike in science." I met Mike and I fell in love with the story. And I said, how have I not heard of science? And so, you know, really for me, one of my big missions was, how do I share our story, right? How do I share a number of these really, really profound, impactful stories that we've helped founders from the very beginning, and let people know, right? And I think for me, the fact that we're in the trenches with a lot of these companies and we are truly a third co-founder with the businesses, I think we know the businesses in and out. And I think for me, just wanting to know how other people are also involved along the journey has been really special. So I think for me, outside of just building the brand awareness around science, I think having partners in science and also all of our portfolio companies as investors, as commercial partners for the companies, building out the network and potential M&A partners, I think has been really helpful for us.
So if you were to describe the story that got you hooked and how the model may have evolved to what it is today, how would you do that?
Yeah. So when I first met Mike Jones, you know, he's very personable, very family oriented, and very humble. And again, I didn't know the story, and really how it was described to me. And I think what I most fell in love with was, wow, we're working with founders who have these great missions. And oftentimes, what we know, you can't build a business alone. And science was there really with the idea to build an entire system around one or two founders and scale them and help them along that entire journey. And it takes a village. I mean, to reach the scale and to really find complementary synergies and, you know what can break along that journey and make those fixes very quickly, I think is super meaningful, especially to an early entrepreneur. So I think what hooked me as well was that at the time, Science had its Fund 2 launched with institutional investors. So kind of where Mike and I also aligned was that I knew some of their institutional investors that were out in the Middle East that were also here in the US with state of Michigan retirement system. And so I think for us, having really strong institutional backing, knowing that we'd have a storied line and path moving forward, I think was really attractive. And I think for me, it was starting to see, like now looking back, how all of these pieces aligned, right? You have a founder journey. We had the four co-founders of science who really were the foundation across each of building each company, whether it's from strategic vision to fundraising to having strategic corporate counsel and financials. Those are the core four pillars of really making sure that a company has a strong foundation. And then building on that, having joined to really build out our partnership network has really been key to helping scale it. So I think for me, what compelled me was working with mission-driven founders and building, I think, businesses that are going to be impactful to the broader economy, I think at large scale. And that's what venture is, right? It's how can we build something that is truly innovative? And we have that opportunity to make those big frontier changes at the earliest stages. So
I think one of the themes that you hit on that's really important is the idea of building a platform as opposed to just a fund. And that's become a little bit more popular recently with some of the larger VCs who have kind of gone out there and said they're doing this, but it's really always been like that in my view. And I think that makes a big difference because it's not just about the capital. It's about all the other things that you can do to help grow a company that you just talked about. And that's where the real value add is. Capital is important, but it's a commodity and you can get it in many places. And sometimes capital is actually bad. You get too much at the wrong valuation, like we saw with this last bubble in 2021, especially, and it can actually ruin your company. You can also get LPs, quite frankly, who aren't aligned, and they can be more pain than they're worth, certainly.
Sure.
Both as a fund manager and also as a founder. I mean, we both experienced that. So I think what you guys have done is great because you've really built a powerful platform to help these companies grow very efficiently. And have you found others are trying to emulate what you've done?
When you think about this, the history of studios, one of the probably earliest was Idea Labs, Bill Gross, right? And it's a model that we were very close to. But sure, there are many that are out there, and all in different forms. We see Human Ventures, who's based out in New York. We've seen companies like PSL or High Alpha. We've seen Atomic, who are building companies internally. So everybody has a very unique flavor. And, I think for us, thinking about a venture studio we've been in that kind of second wave right after Idea Labs. So our platform continues to get stronger, smarter. We have proprietary dashboards that we work on with our companies day in, day out. And that intel only grows as we continue to work with different companies. So but we're excited about the studio platform. One of our investors had spun out to create what's called Volt, and they are a fund of funds of studios. And I think what's really interesting about them, they're having their first summit next month. I think there's this, to your point, meaningful, impactful support across the ecosystem. And I think having different flavors, I think different types of companies that can help scale these businesses is really key. So
one of the things that I'm trying to do in the venture debt space is really bring that platform value add model to folks that we provide capital to, because I think it's been lacking. And we'll talk more about venture debt later, but certainly I think there's a huge opportunity there for ARI because we're very differentiated in that, just like you, my background was in capital markets at large institutions. Having worked at 3 different institutions with more than $1 trillion in assets. I was at Deutsche Bank, I was at Scotiabank, I was at Sun Life, and collectively those are 3 of the largest financial institutions in the world. And I learned a lot there, but what I really gained was access and relationships with the largest institutional investors on the planet. So when I work with startups, and as ARI starts to really scale, which you're going to see massive scaling over the next 6 to 9 months, which is very exciting. People have been waiting, and they're about to see the success take hold. So it's one of the things that we bring to the folks that we work with is access to this different pool of capital, because it's VCs, of course, are very important, but in the grand scheme of things, the amount of money that VCs have is very small compared to large pensions, sovereign wealth funds,
Mhm.
big, asset managers, as you know. I mean, look at the peak market in VC in 2021. It was roughly a little under 350 billion of capital deployed in a market that was booming like it's never boomed before. Yeah, that's a third of the money that Sun Life manages. Yeah,
Sure.
right? Like
Sure.
it's like not even close. I
Yeah,
mean, they
besides,
could
yeah.
fund the entire VC ecosystem, with a third of their balance sheet, right? And so I think a lot of founders don't realize that there are these other pockets of money,
Mhm.
and also potential partners that can help them in various ways, whether it's banking, accounting, legal, technology, that they might not have access to. And
Mhm.
especially on the capital side, most of the founders aren't going to know, who to call at these large institutions.
Yep.
And so it's, being able to provide them with that access is invaluable, just like the access that you're providing to your portfolio companies has been invaluable. And I mean, part of the reason why Liquid Death was so successful, in my view, is because they partnered with science and you were able to actually help them raise a bunch of capital along the way and build their brand along with them.
Thank you. Yeah, no, I think you bring up a good point, right? I think there's so many different ways that people can bring capital to a company or add strategic value, and there's no one size fits all. And at the end of the day, I think that's the key, right? Because there is no one size fits all. As you mentioned, we're still underwriting really great companies, but maybe they're not a fit to go out on their own, or maybe they're not a fit to go with somebody else. And it's similar for you. You're backing businesses that are fundamentally really, really great, have strong underwriting processes, but at the same time maybe they're getting overlooked from other banks. So I think you're providing that, you're filling that gap for people, and I think it's meaningful because at the end of the day, again, how can we make a meaningful impact on this world if we don't help everyone, right? And there has to be a give and take, and I think for you guys to fill that, I think is wonderful.
What's great about gaps is that if you can identify them, not only can you be very, very helpful because you're doing something that other people aren't doing because there's this gap, but you can also generate outperformance
Sure.
because there's a lot less competition in that
Mhm.
space, right? And whatever that space might be, in terms of the VC ecosystem and venture debt in particular, there's a lot of gaps. I always talk about the idea of gaps within the gap. So venture debt, for instance, is underserved in my view. There's less capital available than there is current demand for that capital. But then within the ecosystem, most of the capital, and this is true for equity investors and debt investors, is going to the same types of founders and the same types of sectors in the same regions, right? So think about SaaS companies in the Bay Area led
Mhm.
by white men or Asian men that maybe went to Stanford or Berkeley. Like they're getting a disproportionate amount of capital.
For
And then you've
sure.
got fintech companies coming out of New York, and you've got life sciences in Boston, and you've got some of the CPG stuff coming out of LA, right? And so there's these pockets that are really attracting most of the capital. But what about the rest of the country?
Mhm.
What about the sectors that aren't hot, that don't have AI in the title? What about founders who are women or people of color or military veterans that don't have that same level of easy access that founders in the Bay Area might have? Or what about sectors that are underappreciated at the moment, where you can get really, really great opportunities and be an early equity investor and get great value, or you
Mhm.
can be a debt investor and also get great value because you're not competing against that many other term sheets, if any, because there's nobody looking at these deals. So long story short, I've always said that if you can find the gaps, that's where you can also find the alpha. The alpha is literally buried in the gaps, right?
Yeah, no, I agree. And I mean, it's also, we've thought about this, right? It's where, like, how do you look around the corner, right? You don't know what's around there, but I think having that foresight into how can we think about what's really going to make that difference. So I love that idea.
So let's take a step back, big picture, current state of the VC ecosystem from your point of view in terms of challenges, opportunities, and trends that you're seeing.
Yeah, I mean, we talk a lot about fundraising, right? You mentioned we raised, quite a bit for Liquid Death and obviously announced a big valuation. I think at the end of the day, right, we are underwriting really good businesses, and we're not alone in that. I think everybody is being a lot more scrutinized around what's in the market and being careful in how they're deploying their capital. And so I think so I don't think we're necessarily immune to that. I think it's across venture. I think it's across asset classes where we want to find the best deals, and we're not seeing everyone just quickly to deploy. And and that's great, right? So I think it also weeds out some of those businesses that, maybe a couple years ago, there was this idea of FOMO. So there were these FOMO deals, valuations were crazy, and now we've kind of pulled back. And I think that's healthy for the ecosystem. I think it's healthy for VC. I think stronger underwriting processes. I think finding ways to pull in strategic capital has really helped with that. I think finding ways to ensure that, how can we utilize our resources internally to really help propel companies. So I think for us, a lot of the strategic capital that's coming from partners, corporate partners. So for example, we had Live Nation that was invested in Liquid Death. And I think that's, great because they act as not only an investment partner, but also a marketing distribution partner as we launched into international waters across the UK and select countries in Europe. So I think for us, and again, across many other venture firms, how can we provide that strategic value add to our companies and our portfolio?
Yeah, I think the strategic value add is so critical now, and people are getting more creative around it, right? There's everybody says they're a value add partner,
Yeah.
but most people actually aren't to a very large degree, and they're all kind of running the same playbook, right? And so I think being able to think creatively, say, okay, who are the partners
Mhm.
that could really, really move the needle? And if you're creative about that as an investor and you can introduce that concept and then introduce the actual relationship, I think
Mhm.
that's a huge value add.
Agree. And also be really efficient about it, right? Like at the
Mhm.
end of the day, a lot of it is, time and scale. So how can we penetrate these moats? How can we get to distribution much more quickly? I think at the end of the day, that's what it is. And I think also, that probably relates back to venture debt. Like how can we get these founders to really focus on what they do best? And maybe it's sometimes like, let's not focus on the fundraising. Maybe there are, to your point of like creative financial ways, how can we lift these companies, focus on the business, get to scale and exit? So while building great businesses with good metrics.
There's definitely been a swing from exuberance to risk aversion is kind of how
Sure.
I'd frame it.
Yeah, the
Are
pendulum.
you what would you say founders should do in this market where it's very difficult to raise capital and the bar is much higher than it used to be?
Yeah, I think, I mean, continue to focus on building a good business. I think at the end of the day, it all comes down to underwriting, right? So how can you make your capital go a long way? And what that means is how can you deploy your team more efficiently? Are you hiring the right people? Are you finding the right partners in terms of distribution? Are you being efficient with your time, right? We have 24 hours in a day, and truly, how are you spending that? And I think that comes down to work ethic. It comes down to your personal drive. I think at the end of the day, we have our own personal development that we're working through. And how can you make sure that that translates into the work that we're doing on a day-to-day basis? And so it at core is, how do you build a great business? How do you stay true to your values? And how do you continue to make sure that you're doing what you say? And so I think when it comes down to financing and, running through the business models, I think a few different things that pop out to me is, what is your purpose? Why are you truly running this business? And what does that mean to you? And so we always think about what is that founder journey? What is their story? What really drives them? And ultimately, when it comes down to who are their end customers and why is that customer journey also important, and what does that mean to the business? And so that then flows into how do we think about monetization in all of our models? And that monetization is, now we think about it in its current state. What does that scale look like? And how are we projected to get to exit? And what are those small milestones along the way that we can really get to very quickly. And I think having an understanding as to what that next milestone will be and having that view into it can really help guide what are those next steps in place that I need to do to build my business to focus and make sure that I'm meeting those.
Are there any attributes that you really look for in founders that are most important?
Yeah, I think there's one is again, how true is that founder aligned to their current mission? And I think oftentimes it relates back to a personal story. And if you think back to Liquid Death and the reason why we wanted to remove plastic, I think back to uh, one of our Fund 3 companies called Mindset Care, which is helping to tackle homelessness and recidivism through turbo-taxing an efficient way to apply for Social Security and disability benefits. And it goes, if you look at the story of Darren, who the founder is, he has a personal connection to it. And it was something that he knows the process in and out, and he understands what those challenges were. And I think if you're so deeply affected by something and you want to see that change and you start to see that drive in them, it's really special and it's really magical. And having worked with one of my partners, Peter, on these raises, I think when we start with the businesses and we think about what their pitch is and what it starts out as and what we end up going into market, it's really beautiful as we start to unfold why these founders are actually running their business and really who they want around the table with them, right? They've chosen science as a partner for a reason. And it's our duty as well, and our fiduciary duty, to make sure that we bring additional strategic players around the table with them. So I think the openness of founders to really know what they know and have that purpose and have the openness to want to bring on the best of the best and surround themselves with to really scale their business, I think that's really wonderful. And so I get excited every time we work with these founders and I can see it. And I'm just so grateful to be in the room with them.
So when you're evaluating companies outside of the founders and perhaps their leadership team, what are the other investment principles that you're thinking about and applying in your investment process?
Yeah, so it's a pretty rigorous investment process. So we have our studio team, which is essentially a portfolio operator. So if you think about like a KKR Capstone or Cerberus, right? They've purchased an asset and they're deploying their portfolio operations to ensure that they're capitalizing on efficiency, or a number of other areas. We do that on the earlier end to de-risk our investment. So how do we work with the founder, especially early stage, right? We want to know the businesses in and out. What are some of the breaks that we would see? And we operate in very distinct models. So CPG, with consumer packaged goods, mobile media, and marketplaces. And so what that means is we have very distinct metrics that we're meeting under each of those business models. And we know if we're not meeting certain metrics, we know it's not going to run. Or we know if we're not meeting it, what are some of these changes, small changes to make to actually get us to those milestones. So I think from thinking about a business model, then the underlying metrics that we would need to meet, the founder's work ethic to get to those, the external validation of the partners that we're bringing on. I think that's super key, because the partnerships are what helps us develop that moat to create that scale and efficiency. And so I think for us, it's metrics, partnerships, the team, and certainly the finances. I think the finances are absolutely key and critical, because we want to make sure that a business stays on track and has the ability to scale appropriately. So I think for us, those are the certain, obviously there's a lot more into our investment process, but at high level, it's a rigorous process that runs through the studio, is reviewed by our investment committee at the fund level, and we make our investments. And at times we will tranche our investment, and we're not making those investments in full on day one, because again, we want to be able to maximize the efficiency across our capital and also ensure that the companies are really making those movements.
So there are a couple of things I wanted to dig into that I agree with. One is on the liquidity side, and
Mhm.
in general, just having the cap structure or capital table optimize from the beginning is
Mm,
very important. And I've talked about this before in the sense that you can sell too much equity early on, and therefore there's not enough left to give to later investors. You can
sure.
also, sometimes with later stage companies, over lever yourself. You don't want too much debt. You want an optimal amount of debt, right? And so there's a lot to be thought about early. And if you begin with the end in mind and work backwards by starting early, at the stage of the companies that you're dealing with, I think that that's really helpful because a lot of companies have great ideas and even have good leadership teams, but they don't necessarily have the right capital structure, and it's so hard to unwind that. If you've given too much equity to the wrong investor, early on, it's very, very hard to recover from that. The other thing I wanted to mention around liquidity is that sometimes it's not the best company that wins, it's the company that lasts the longest. And so that's something I talk about a lot, is really thinking hard about one's liquidity and having more than you need, because things will always take longer than you think as a startup. They're never going to come out as you planned. Usually they're going to, you're going to have to pivot multiple times. And oftentimes that's not positive, or sometimes you're pivoting because things aren't going well. And
Sure.
so having a lot of liquidity, I think, is important. Having enough equity in the tank, to use later is really important, not only for external investors, but also for your employees.
Mm,
I mean, one of the problems that startups are facing now, actually, I wrote an article recently called "How to Avoid the Startup Death Spiral."
oh gosh.
Um, so unrelated to liquid death, but essentially, when startups valuations have cratered like they have in the last 2 years,
Mhm.
sometimes through no fault of the company, but just because the macro environment has changed, like it has in the last couple of years. Well, when the valuation craters and you're down anywhere from 50 to 90%, like a lot of the companies from the 2021 vintage, well, what does that mean? It means the equity that you gave employees, the stock options, they're worth zero basically. Like they're almost never going to be worth anything that's material to the employees. And so a lot of the better employees are going to be incentivized to leave.
Oh,
It
sure.
also means when you go to raise more capital, well, now you're raising at a much lower valuation, and you also have less credibility because in your last round, you're raising at a much higher valuation. And so not only do you have less equity to sell, but you also have less credibility in the market. So this quickly becomes truly a death spiral because good employees leave. Now your operating metrics start to suffer, your revenue growth slows, that impacts your valuation further, and before you know it, you're dead. And essentially, or I think you have a good point to make. It's
No, no, I'm saying I totally agree.
yeah,
And I think, which is why I'm so grateful to, I mean, Tom, Dare, and Rob, who's our CFO of our fund, to understand these. Exactly to your point, it's if you don't have those outlined from the very beginning and continue to monitor those finances, I mean, that could truly kill your business. And I think having an understanding as well about the different financial products and the different ways that these businesses operate, not every company is made the same. Not every company needs the same amount of capital. And so I 100% agree with everything that you're saying.